Colin, welcome back to another episode of What Just Happened. I've got two things for you today. One that I think you'll be more excited about, one that I think I'll be more excited about. Where do you want to start?
I want to start off being really excited. So why don't we start there?
We're bringing the heat today. So here's the thing. This is something we've talked about before. So I'm just going to share my screen and have you take a look at this and get your thoughts. What are your thoughts on what we're seeing here? I'll tell you what this is. It's
Okay.
coming from Urian Timmer at Fidelity. And one thing that we talked about before in this space, in our podcast, in various conversations with clients, is the concentration that we're seeing in the market right now. And
Mm,
the reason we're talking about it is not because you and I are worried about it, but because it makes headlines and other people are worried about it. You know, the top 10 stocks, the top 7 stocks, the top 50 stocks, they're all too big and they all make up too big a part of the market. So this is showing us today the top 50 versus the bottom 450 in terms of market cap in the S&P 500, right? And you can see we're creeping up there. Like it's 61% is in 50 stocks, and that sounds really bad. But historically, it's not all that abnormal, and I'm not sure there's anything that you can discern from it.
So, just to break this down a little bit further, because not everybody knows this, but in the S&P 500, the stocks are not equally diversified. Normally, you have your FANG stocks, or at least over the last however many years, the FANG stocks have made up the majority of the S&P 500. So think your Facebook, your Apple, Nvidia, Amazons, all of those guys, Google. But here what we're seeing is that when we look at the full 50 stocks, it's 61% the entire S&P. So the bottom 39% is made up of 450 stocks. Now, a lot of people think that that's not very well diversified, but actually, Ben Graham and a lot of other people said to have a diversified portfolio, I believe you need 22 stocks. So it's actually decent diversification. And I would have thought actually this would have been more concentrated.
You know, it's a good point that there is still diversification, and I think the weighting, how much risk is associated with those top 50 names and their success, is what people are worried about. But the S&P 500 is a momentum strategy, right? You
It is.
reward the companies that are doing well; they get a bigger part of the a piece of the pie, and the ones that aren't doing well get kicked out, right, and
Right.
replaced with somebody new.
Yeah, it's like, if you own Nvidia in your portfolio, say you bought a basket of stocks and you had $100,000 and you put 10,000 into 10 stocks and Nvidia was one of them, if Nvidia goes from 10,000 to 20,000 and then 20,000 to 100,000, are you going to keep selling it along the way, or are you going to let your winners run? And the S&P by nature is going to let its winners run, which increases the concentration within the S&P 500. And it does inevitably kind of rebalance along the way, but it, like you said, it's a momentum strategy. So there's always going to be some form of concentration. What I'm curious about is what this is showing us about recessions.
Yes, the thing I think that the two big takeaways we have here are all the way on the left hand side. You can see the impact of like the Nifty 50 era of the stocks, right? And back in the let's call it pre-80s days, it was very normal to have a majority of the S&P 500 be in 50% or 50 stocks or more, right? That was very, very normal. And then we started to see more recessions in like a big, let's call it flashy type of way, right? You have the tech bubble in here. You have the reset or the Great Recession. The recessions of the 70s were like stagflation recessions. It didn't really make any difference in impact on the how much we had in those big companies, right? But what I think is really interesting is this 2008 scenario, because that's the one that we always talk about from
Right.
planning purposes, right?
Yeah. And when I look at that in 2008, there's actually not that much concentration.
There's not. There's very little leading into it. And I think partly that's because we were seeing a shifting gears, right? Because we had tech kind of blow up at the beginning of 2000, right? And then leadership used to be financials, and then financials fell off in terms of leadership with that great recession.
And now it's
And
back to tech.
and now it's back to tech. And I think you had that period of time where there was like a changing of the guard, like a regular changing of the guard. And that's I think what we're seeing here, bottom line, is that if there's something to worry about, it's not concentration.
No, and what's kind of fascinating about this is that if I look through it, I mean, this chart has a lot of graphs and or peaks and valleys, so to speak, but the difference between the Great Recession to now is only 5 to 7%. And then the difference between the dot-com bubble to now is only, 1 or 2%. But with that being said, even when it was, pretty big in this chart, the difference was only like 8 to 9% is the biggest concentration difference really that I'm seeing at the headlines in terms of peak and trough.
Yeah, no, I think what you had during the 80s and during the 90s, for the large chunks of those decades, it was a little bit more diversified. And those were pretty good decades. So I think it's hard
Yep.
to argue against that. I just don't think that there's a causality here. I don't think there's something like this means this. It's just a fact check that we're looking at.
Well, and it makes sense too, right? In the 90s, it wasn't one particular sector that was necessarily dominating the growth. It was a lot of sectors were doing extremely well. So inherently, it's going to be more diversified because you have momentum across a bunch of different sectors.
Yeah.
This year you have less sectors doing as well. And that's going to lead to more concentration, especially in tech and AI.
Yeah. Yeah. So the question is, I guess, do other sectors, other areas of the
Catch up.
market catch up, right? Which, who knows? All right, I got one more chart for you. I'm going to stop sharing and bring it up. And this is the one that I think is a little bit more interesting overall in terms of what it's telling us about where we are, where we're going, etc. We talk a lot about why the market is going up, or really clients, I feel like they really want to know why the market's going up and if it's going to keep going up. And so that's something that I think we should spend some time on. There's JP Morgan's one of our trusted resources here, and everybody has a blog, which is, fine. And then now everybody has a podcast, which is joining our club. I guess we're members of the club now.
People could argue we're joining their club.
Yeah, that's fair. They were here first. So this is a blog slash podcast from JP Morgan. The title here is the Data Center Blob. And there's a lot of really interesting stuff in here. Michael Semblis is a pretty smart guy. There's a lot to pick up from him. In part way down, actually, I'm going to just zoom in. You can see a little bit more of the screen. Here's Michael paused in a very unflattering way. And next to him, you have the explanation of the resilience, his explanation of for the resilience in the stock market. And I think that there's a lot of things that are creating resilience. It can be the fact that we have so many V-shaped recoveries and we're all kind of trained to buy when the market goes down because we're rewarded very shortly thereafter. There's another thing that he's pointed out that I think might be even more impactful, and that's that there's $1.5 trillion in contributions to 401k, 403b defined benefit plans in any given year now. That's the number that we hit in 2024, and we're expected to go beyond that in 2025. So you kind of have a relentless bid of new dollars going into the market. And what Michael's pointing out, in addition to that, is those dollars don't have as many places to go. So what we're seeing here are the number of IPOs or new equity options that come into the total stock market. So not just the S&P 500, but the market at large. And we are basically at all-time lows in terms of new equity opportunities in publicly traded sectors. So private sectors, private equity, totally different game. But outside of, let's say, the SPAC boom of 2020, 2021, we've essentially seen fewer and fewer IPOs, fewer and fewer options coming to market, which means that there's fewer and fewer places to put your money, which is partly what's leading to that concentration we were just talking about and the leadership in that area. And partly what's propping up this market, I think, because in those 401k plans, you don't have Bitcoin in there as an option. You don't often have gold as an option. You don't have a lot of private equity and private credit, although that's starting to sneak in there. So where else are you going to go if you're putting your money to work? It's going to go into the market, right?
I think people I don't think I know that people often come to us and they say, oh, well, this political statement is going to cause the markets to go down, or this situation over here is going to cause markets to go up, or this war is going to make X, Y, and Z difference. What makes markets go up and down is supply and demand. And it's just like any other good that's out there. And that's what's being referenced here. People who are buying stocks are going to make the price go up. And if you have a bunch of people flooding into one particular investment, then the price of it is going to go up because there's less supply of it and there's a lot more demand. And to echo what's going on here, when we sit down with clients, I don't know about you, but I traditionally advise them in their 401ks. By no means is this investment advice for people watching, but to lean more into domestic equities and the S&P 500 because that's where you're going to get the most momentum and it's where historically we've seen a lot of growth. So that's the easiest thing to do, which aligns perfectly with this chart. If we have a lot of people who are contributing to 401ks and employers are giving company matches at 3 to 5%, ultimately what that's going to do is buy more of the same stocks that we were just talking about that are fairly concentrated and diversify amongst other S&P 500 sectors, which will inevitably cause the markets to rise over time. And when people say markets tend to go up, that's true. And that's because when money is generated, it tends to flow into the market.
Yeah, I mean it is like I said, it's a relentless bid. And the majority of these assets, to your point, are going into the S&P 500. Some of the target date funds are certainly becoming more popular, but they tend to be more popular with, let's call it, the lower end of the contribution spectrum, the people who are
Yep.
not paying as much attention to how they're invested. And so, we have the home field bias. We're not going to naturally, the U.S. investors are not naturally going to invest in emerging markets or in foreign domestic or foreign established international or bonds, even since bonds have been such a joke lately. So I feel like this is where people are going. It makes a lot of sense. And I don't know what changes this. Like what if this is the thesis, if we have fewer and fewer options and more money coming into play, what stops this from continuing to support the market in the long run?
Well, nothing. I think the only thing that could stop this would be a dramatic change in unemployment. Like if you had a dramatic change in unemployment that meant that there were fewer and fewer contributions to retirement plans and matches going in there, that could slow expectations, which could then have a pullback in market performance. But to your point, it would need to be a fairly dramatic change in order to combat this relentless bid that's always going on in the markets. Because if people are making money and if companies are earning money, it's going to be going into the markets in some way, shape, or form, whether that's through retirement plans or just profitability in stock, which is causing their own bid to go up on their own. So, to your point, I don't know what could stop this. And in my
Yeah.
mind, this is why I think we're generally bullish.
Well, that's true. I mean, it would have to be a massive amount of unemployment too, because the
Huge.
people who make the most money are the ones that put the most into the market, right? So you
Right.
have to hurt, and we've talked about this before, the number one driver of consumption, or the biggest driver of consumption in this country, is the wealthiest sector of the country, and second to that, it's retirees. And those retirees aren't doing they're not making the contributions into the 401k anymore, right? So
No.
they're not part of that. So they're a totally separate ball game. But I feel like it would, if you lay off the bottom 10% of earners, and I'm not trying to be cold hearted, but those are the people who will struggle the most in rising unemployment. That's not going to have as much of an impact on that $1.5 trillion going into that area.
No, and speaking of retirees too, the stat that we were just talking about in a prior podcast was 80% of, or most retirees in general, end up passing away with still 80% of their assets that they even started retirement from. So when you retire, and that accounts for inflation too. So basically, when you retire, most people go through retirement hardly actually tapping and selling off a lot of their investments. So that's not even making that big of an impact.
Yeah, and think about it, like if you let's say you're not unemployed, but you're just starting to tighten the purse strings because you're worried about the economic environment. People treat their retirement savings as a bill. It's an automatic thing. This contribution to the 401k is not something that a lot of people are going to log in and tweak. It's certainly not going to be the first lever that they pull. So it would have
No.
to be a big systematic issue.
Yeah, for sure. I mean, it's fairly seldom that we have conversations with clients where if they are struggling to make ends meet necessarily, that they're turning their 401k contributions down by 1 to 2% to make the big difference. That's not usually someone's first step. And if that's the case, then what we do know is that money's going to continue to flow there. And I think that's generally a pretty good argument that as long as we're in a capitalistic society and people are making money, money is going to flow into the market. It's just natural.
Yeah. So market can go down, stocks can go down, right? I think this is just a matter of what the floor might look like underneath and what our expectations for the downturn might be.
I agree. Yep. It's going to be interesting to see how it all turns out, but it's a very interesting, I'll say, exercise to go through the charts and actually have a reminder about what's driving growth now and probably in the future as well.
Yeah. I'm trying to stay positive, Colin.
I think you're doing a good job.
All right. Thanks all. The information in this material is for general information only and is not intended to provide specific advice or recommendations for any individual. Investment advice offered through Integrated Partners, doing business as Ko-Fi Advisors LLC, a registered investment advisor. Integrated Partners does not provide legal, tax, mortgage advice or services. Please consult your legal tax advisor regarding your specific situation. Past performance is no guarantee of future results. All investing involves risk, including loss of principal. No strategy assures success or protects against loss. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that the strategies promoted will be successful.